Hello and welcome to SWAG Academy. So what is profitability ratio analysis? Profitability ratio provides information about the ability of a firm to generate profit and meet its stakeholders' interest. A ratio tells us how much from one thing we have compared to another thing. Profitability ratios measure how efficiently a business generates profit from four different things: revenue, assets, equity, and capital employed. We can break them into margin ratios and return ratios. Margin ratios compare how well a company turns revenue into profits. Profits are subclassed by three types: gross profit, operating profit, and net profit. Before we continue, it is important that you are familiar with the basic structure of an income statement and balance sheet. Let's begin with the margin ratios. The gross profit margin equals gross profit divided by revenue. In other words, revenue minus cost of revenue divided by revenue. You can find both revenues and gross profit in the income statement. A company with a high gross margin compared to its peers likely has the ability to charge a premium for its products. It may indicate that the company has an important competitive advantage. Some industries experience seasonality in their operations. For example, retailers typically experience significantly higher revenues and earnings during the year-end holiday season. Thus, it would be most informative and useful to compare a retailer's fourth quarter profit margin with its own or its peers' fourth quarter profit margin from the previous years. The software industry has the highest gross profit margins. The retail industry has the lowest ones. Pause the video and check the average profit margin by industry. Operating profit margin equals operating income or EBIT divided by revenue. Operating margin is the percentage of sales left after accounting for COGS as well as normal operating expenses like sales and marketing, general expenses, administrative expenses. It compares operating profit to revenue. Operating margin can indicate how efficiently a company manages its operations. That can provide insight into how well those in management keep costs down and maximize profitability. A company with a higher operating margin than its peers can be considered to have more ability to handle its fixed costs and interest on obligations. It most likely can charge less than its competitors, and it is better positioned to weather the effects of a slowing economy. Net profit margin equals net income divided by revenue. The net profit margin or net margin reflects a company's ability to generate earnings after all expenses and taxes are accounted. It's obtained by dividing the net income into total revenue. Net profit margin is seen as a bellwether of the overall financial well-being of a business. It can indicate whether company management is generating enough profit for its sales and keeping all costs under control. Its drawback as peer comparison tool is that because it accounts for all expenses, it may reflect one-time expenses or an asset sale that will increase profits for just that period. Other companies won't have the same one-off transaction. That's why it's a good idea to look at other ratios such as gross margin and operating margin, along with net profit margin. Next comes the return ratios. Return ratios measure how much profit a business is able to generate based on its assets, equity, or capital employed. You can find all three of these in the balance sheet. Let's begin with return on assets. Return on assets equals net income divided by the average total assets. It is analyzed in comparison to assets to see how effective a company is at deploying assets to generate sales and profit. The net income is found on the income statement. The assets are found on the balance sheet. The more assets that the company has amassed, the greater the sales and potential profits the company may generate. As economies of scale help lower costs and improve margins, returns may grow at a faster rate than assets, ultimately increasing the return on assets. Return on equity equals net income divided by average total equity. The net income is found on the income statement. The equity is found on the balance sheet. Return on equity measures how a business uses its owner money to return profit. Return on equity is a key ratio for shareholders as it measures company's ability to earn a return on its equity investment. But there is a problem. Some businesses choose to take out debt to finance their operation. This reduces the owner claim on net assets and it can inflate return on equity. The ratio can rise due to higher net income being generated from a larger asset base funded with debt. A high return on equity can be assigned to investors that a company may be an attractive investment. It can indicate that a company has the ability to generate cash and not to have to rely on debt. Return on invested capital equal net income divided by invested capital, in other words, equity and debt. You will find the net income on the income statement. You will find the debt and equity on the balance sheet. This return ratio reflects how well a company puts its capital from all sources, including bondholders and shareholders, to work to generate a return for those investors. It's considered a more advanced metric than return on equity because it involves more than just shareholder equity. Return on invested capital compare after-tax operating profit to total invested capital, again from debt and equity. It is used internally to assess appropriate use of capital. Return on invested capital is also used by investors for valuation purposes.